Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 3rd of September 2018 and we're going to talk about emerging markets and how they can have a profound effect on gold and silver prices. But first, a slight rant from us and a word of caution to you, our listeners. We have spent the weekend and today listening to so-called YouTube experts with strong subscriber bases correctly stating that what is happening in emerging markets is affecting the price of gold and silver, and then postulating a vast range of theories, most of which are wrong, in the hope that by covering every possible eventuality they successfully justify their conclusions, which they actually arrived at by watching and listening to pumper and conspiracy theorist channels themselves, because most of them have zero experience in international finance, trade and currency swaps. In other words, they may have got the conclusion right, but do not have any idea how they have arrived at it. This truly makes our blood boil, because we here, their subscribers, pay them homage so that when their next pumpers video comes out about black swans, precious metals about to fly to the moon, or the dollar is about to collapse, they believe them without realizing they are being conned. This is history repeating itself, as we have seen from 2011 onwards, these pumpers encouraging people to put most of their wealth into gold and silver because their prices were not only going to recover, but double or treble or quadruple in months. Now let's just add that if someone says, I've been following this subject, but I don't really know what is happening, but this is my educated guess based on the information I've read, and this is the conclusion I've come to, then fair enough. But if they say, emerging markets are having a profound effect on the price of gold and silver, and will continue to do so for some time to come, and then not stipulate what that effect is, or how it came about in the first place with precision, then sorry, we get truly annoyed with these people who are trying to educate their audience about subjects they know little about themselves, and could very well lead them into a cul-de-sac. What almost all of them have failed to mention is that the situation with the emerging markets and their currency devaluations is precisely because what has happened to the US dollar in the first place. The US economic policy, and more precisely its currency policy, has led to this crisis, compounded with those countries affected not putting in place the economic regime or infrastructure they should have done in the beginning. Let us explain. And you probably won't get this from these channels that have set up recently, claiming to talk about and educate you on world affairs and economics. The US dollar remains the single most important consideration for emerging market finances. Why do we say this? The most important reason is the rise in the local currency cost of servicing dollar-denominated debt. Borrowing in foreign currency on a meaningful scale is almost entirely an emerging market phenomenon, spurred by the underdevelopment of local capital markets, which is typically associated with low domestic savings, in turn often caused by recent experience with or lingering memories of relatively high inflation rates. That means if you are a country, as these are, which have previously experienced high inflation, prices going up, you as a citizen and a nation are not going to save, but spend now because you know you will be able to buy less with that currency tomorrow. These conditions are evident in Argentina and Turkey, both of which have been in the crosshairs of recent market turmoil. Although the increase in emerging market foreign currency borrowing over the past decade, dominated by the US dollar, is much more widespread. Dollar funding has been cheap and plentiful, and emerging markets have responded accordingly. So what has exacerbated this situation? Well, the recent strength of the US dollar, which is up 3.5% to 4% in nominal effective terms since late January, following a 2-year depreciation, is causing investors to reevaluate their emerging market exposures. So if January was in fact a dollar inflection point, and the trend is for further dollar appreciation, then in the local vernacular, emerging markets are stuffed, or in gentry speak, in line for a very difficult time. So in the most simple terms, these countries have been taking out US dollar loans to finance their economies. Instead of creating a wealth structure and encouraging savings, they have basically misspent these monies. Now the dollar is beginning to rise, they cannot afford the loan repayments. This puts pressure on their own currencies, which were already under threat, making the situation even worse. On top of that, President Trump imposes tariffs on these countries' goods, and so they cannot even trade their way out of the situation. So those who have investments in these countries move what monies they have out of the local currency and into the ever-strengthening US dollar, which in turn strengthens it even further. So when you hear these idiots or deceivers on YouTube telling you, beware of the US dollar imminent collapse, they just simply do not know what the heck they're talking about, or are trying to encourage you to buy gold and silver now before it's too late. The second reason for a strong dollar posing challenges to emerging markets is the usual inverse correlation between the dollar and commodity prices, with some important exceptions including China, India and Turkey. Emerging markets as a whole are net exporters of commodities. Leaving aside all other considerations with respect to what might drive commodity prices, the dollar price moves inversely with the dollar nominal exchange rate. This was apparent most recently in the 2014 commodity price collapse that was mirrored by a strong surge in the dollar. With oil currently trading at a 4-year high, it is clear that the inverse relationship between commodity prices and the dollar does not always hold. But the implications and importance of the dollar as the world's currency, or number one currency, cannot really be a point of debate. Other factors may cause temporary or even extended interruptions in the correlation, but as long as the dollar retains its global pricing role, and this is the key message, as long as the dollar retains its global pricing role, it will be a driver of commodity prices and the overall emerging market current account position. Weaker emerging market currencies should stimulate net trade and growth in the short term, but this is adversely affected by tariffs. Notwithstanding this, medium-term growth is driven more by investment, especially in emerging markets that need expanded capital stocks to harness the potential economic windfall associated with favourable demographics and rapidly growing labour forces. The overall growth impact will depend on whether the effects of local currency depreciations are larger on net trade or investment, and the time frame considered. A final impact is how the central banks operate their exchange rate policies, floating or fixed or shadowing. Now, we won't go into this because it is so technical and boring you will stop listening to this video if you haven't already done so already. Needless to say, the net effect is, if they get it wrong, which they broadly have, emerging markets' external balance sheets are hit doubly hard by dollar strength. So there we have it in a nutshell. Emerging market currency failures because of borrowing too much dollar-denominated debt and not structuring their economies correctly to manage it further cause investment capital to leave their country and flee into the US dollar, thereby strengthening the dollar further, resulting in lower commodity prices such as gold and silver. And this is likely to continue while the emerging market crisis plays out. Economists differ as to which countries may fail first or the most, but Adam Slater of Oxford Economics, based on his calculations, state that the first major wave will be Turkey, Brazil, Chile and Malaysia, followed by a second group of Colombia, South Africa and Argentina. We shall have to wait and see if he's right in terms of pecking order, but the writing is on the wall for these countries, unless the US changes its interest rate policy and begin to lower rates, and for the US dollar to fall, which is very unlikely to happen while the US adopts a US first policy. Let's just wait and see. But please heed our caution. Be careful to whom you are listening, and the authority and experience that those who profess to guide you actually have. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on Twitter. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.